Okay, I wanted to do a real quick video also on what the opposite of selling a naked put and a naked call is. You might have heard like, oh, you should buy options, or you can do whatever you want. Let me just explain to you how it works on Doe and what that all that means. So what I'm going to do here is open up your Doe platform, open up to click on trade. I'm typing in SPY for the S&P 500. Okay, I'm going to zoom in a little bit. Okay, so if selling a naked put is a bet that the stock will go up, what's the opposite of that? The opposite of that would be buying a put. So real quick review. Selling a naked put means, I'll go here, we'll do a short put here, we'll go like this. All selling a naked put is, if you sell a naked put, you're betting that the S&P 500 will stay above $190. As you can see here, the S&P 500 at 200.51. So selling a naked put is a bullish bet. You're betting it'll go, the stock will continue to go higher or stay above whatever strike price you sold. In this case, it's the 190 put. Okay, that's selling a put, a naked put. Well, what is selling a naked call? We went over that in the previous video, but I'll do it again here. Short call, hit go. Here's a short call, and in this case, we are selling a naked call. Means is a bearish bet, meaning you're betting that the stock will stay below $215. So you're betting it'll go down. Okay. Now, what are the opposites of these two? Well, if you want to make a bet that the stock will go up, you can also what's called buy a call. All right. So the difference is, instead of collecting money, you actually have to shell out money. Okay. So I'll show you one thing here. If you buy a long call, it's called buying a long call. See up here, the green area is where you make money, right? So in this case, if you buy a 205 call, you're betting that the stock will be above $205 at the end of expiration, which in this case is end of October, so in 48 days. Okay, so the green area is where you make money. Well, the S&P 500 right now is at $200.51. It's got to go up $5 just for you to break even, right? Your chance of profit is 30%. So what you can do is you can move your call where it's currently below the current stock price. In this case, our current stock price is at $200.51. You can buy the $200 call. Pay attention to this part, it's important. So you're buying a call, you're making a bet, in this case, that the S&P 500 will stay above $200 at the end of 48 days. Okay? You might be thinking, well, that's a great bet because the S&P 500 is already above $200, right? Correct. The problem is you have to pay $3.06 for this option, which means to even break even, the stock at the S&P 500 has to, your break even point is this strike price of $200 plus what you paid for it. That means to make any money, the S&P 500 has to go up to $203.06 before you make any money. Okay, that's why you notice the green area starts right around here, not all the way down here. You're paying to play. All right. Now, what are the chances of that happening between now and 48 days from now? You have a 40% chance of being correct. Okay, this is why the tasty trade way, or the golden gecko way, is to sell options, not buy options. Okay. Why? Because it's harder for you to lower your cost basis, because your cost is not $200 anymore. Your cost is $203.06. It's trading for $251. Okay, so that means you're still behind, and you only have a 40% chance of being right. Now look, you could move the strike lower and say, okay, what about $199? Sure, it's better, right? But you have to pay more. So your break even is still, you're not you're not improving your probability of success. Okay, but I did want to illustrate what buying a call is versus selling a call is, or selling a put. Okay, we already covered what selling a call was. Selling a call is opposite of this. Okay, so if I hit swap right here, look, if you sell a call, all right, selling a call is bearish. You're betting that the stock will be below this price. Okay, buying a call is bullish. You're betting it'll be above a certain price. The difference is when you buy a call, it's a debit. You pay for something. When you sell a call, okay, you're receiving money. You're selling something. Okay. Well, let's go to buying a put. If selling a put is bullish, buying a put is bearish. Okay. So when you buy a put, you're betting that you want the stock to go down. Okay. But because you're buying it, you have to pay for that. Okay. So in this case, I'll move the strike up here, 202. If you buy a put on the S&P 500 at $202.50, you're making a bet that the S&P 500 will stay below this number, $202.50, at the end of expiration, which is saying 13 days or whatever the expiration date is. All right. Let me change that here. Buyout. Let me change the actual what do we do? We're doing a long put. We'll do 45 days. Okay, go. Okay. All right. Oh, whoops. Sorry, my bad. All right. So again, though, you have to pay for this. So let me show you what I mean. Okay. So in this case, you said, well, that's a good bet. S&P 5 is $200 now. If you buy a put, the green area is where you make money. So you're betting, when you buy a put, you're betting that the stock will stay below this strike price, $205. That's pretty good, you're thinking, right? Because that's $5 above its current price. Again, remember though, you have to pay for this. So since you're paying $6.25, okay, and you're betting that it'll go down this way, you have to subtract $6.25 from this. Okay, that means if you click on here, what that means is if the price of SPY has to be less than $190.75 for you to make any money. Okay, why? $205 minus 625 equals 198.75. So for you to make any money, for example, if the S&P 500 stays right where it is, you lose money. Okay, it has to drop down to 198.75 for you to begin to make money. Okay, so it has to drop over $2 for you to make any money, and you're paying for this. Now your risk is whatever you pay for. That's when you click on this. Your profit is unlimited. You can make unlimited money depending on how far it drops. But your loss is strictly defined to $625. Your loss is what you paid for it. $6.25 per contract. There's 100 shares in each contract, so the most you can lose is $625. Okay, but your probability of success is below 50%. How do you change those probability? Well, you can move your strike price closer in, right? So let's say I move it down. The problem with that is, look, okay, Mark, I will bet that the S&P 500 would be below $200. Well, what is it now? $251. So I'm already winning, right? Correct, except for the fact that you have to pay for this. So now that means it's $200 minus $3.37, which is down here, 196.63. So now you have to pray when you make this bet. You're betting that the S&P 500 will drop below 196.63 before you even begin to make a penny, and the odds of that happening are 34%. Okay, that's the difference between buying a call and selling options or buying options. Okay, so let me clear this again. I do a real quick review, and I'll do it from the standard of how most people do it. And I'll use a different example here because maybe most people don't know what S&P for beginners. Let's say you're making a bet on Apple, and you go, what is Apple trading for now? Okay, well, the answer is right here. Apple is trading right now for $102.55. Okay, the average person will say, okay, I want to make a bet that the S&P 500 will go up. Okay, well, to do that, a lot of people, you could buy options. You'll hear that a lot. Okay, you can buy options. Okay, but you can buy options. The problem, and let's see what happens if you buy a call option. If you buy a call option, you're betting it'll go higher. So here, long put, and then you're buying a call, buying a put, or buying a call. We'll check on buying a call. Okay, so the green area is where you make money. Apple is at 102.55. Let's say you buy the 102.14 call. That means you're betting that Apple will stay above $102.14. That's pretty good, right? It's already above that. But don't forget, you have to pay for this option. Okay, so you have to pay $3.75. So you have to add $3.75 to this 102.14. Okay, which means for you to make any money, Apple has to get above $105.89. Okay, the chance of that happening by the end of your expiration date is only 35%. Okay, so that's if you're betting it'll go higher. Well, God, you're thinking, I don't want to do that. That's pretty hard. Is there any way I could maybe better my odds? Sure. What's the opposite of buying a call? Selling a put. Okay, so I will clear this, and we're going to make the same bet that Apple will rise. But let's see how you can improve your odds. You go to selling a put. So short put means selling a put. Hit go. Look at the difference. I'll move the strike up to the same thing. I'll move it up here. I'll move this whole thing down here. Apple again is at 102.55. I can move my put here, right? And you're betting that, of course, you're betting that the stock Apple will go higher. Well, if you sell the 171 put, okay, or I can even move it up a little bit more, the 101.43 put, or even the 102.14, the same one as we did the call. You're betting that Apple will stay above $102.14. Look where the green area is, though. The green area starts below 102.14. Why? Because instead of paying $3.05, you're collecting. You are getting paid instead of paying. So someone else is going to pay you $3.20 because they think that Apple's going to go lower. You're betting that Apple's going to go higher. Now, so you're making a bet that the stock will stay above $102.14. But because you're collecting $3.20 for that bet, your break even when you make money is actually below this number. It's 102.14 minus $3.20. So you gained like a little margin of safety. So if I click on this, okay, if Apple winds up being greater than only $98.94, okay, you make money. Why? 102.14 minus $3.20 is $98.94. All right, and look at your probability of making a penny of making money is 64 cents. That's the difference. Now, what if you're bearish and you go, I think, but Mark, I think Apple will go down. Okay, well, repetition is the mother of learning. If you want to make a bearish bet and you think Apple will drop, you can either one, buy a put, long put, go, and you can make a bet that Apple will stay below let's see, 102.86. Okay, it's at 102.55, so you think you're ahead of the game, but don't forget, you have to, when you buy something, you have to pay for it. So you're paying $3.65 for this option, which means Apple has to not just stay below 102.86. Apple has to stay below 102.86 minus what you paid for it, $3.65, which means you have to pray Apple gets below $99.21 before you make any money. What are the odds of that happening by the end of your expiration date? Only 37%. Okay, or so Mark, I don't like those odds. What else could you do? Well, you could sell a call. Short call, you could sell a call. So we can go back to that same strike price, right? Which is right around here. I think, what do we say? 102, oh no, 102.86, let's say, right? Well, in this case, you're making a bet. The green area here, you're making a bet that to make any money, Apple has to stay below 102.86. The difference